So just welcoming everybody today to another social impact measurement topical interest group webinar. This is through the American Evaluation Association. And for those of you who are not familiar, the American Evaluation Association is a professional association of evaluators devoted to the application and exploration of evaluation as a profession. AEA has approximately 6,000 members representing all 50 states in the US, as well as more than 80 foreign countries. We will share a little bit more about the American Evaluation Association in a link in the chat. With Slavi and Ben, who are on the line, my name is Lissa Glasgow, and I'm a webinar co-chair of this group. So we do a couple of different webinars throughout the year. We've got some really exciting one coming up in the next couple of months, and we're really excited about this one today. A little bit about the social impact measurement group, topical interest group, the SIM TIG. It's a very long acronym, so we'll refer to it as the SIM TIG as we go along. We're a group of AEA members who are interested specifically in the topic of social impact measurement and management. And we explore the interplay between social and financial return of investments. We come from many, many, many different backgrounds. Those of you on the line who have been to these meetings before know how diverse the backgrounds are here. From evaluators to evaluation commissioners, we have investors, companies, investees. Membership in our topical interest group means that you want to learn more about evaluating the social impact of organizations that are aiming to produce both a social and a financial return, whether you're at the forefront of that work or you're just learning about it for the first time. We always welcome new members, and we're excited that you're here. I'll also share a link about the SIM TIG in just a moment. All of our webinars are recorded. Slavi just started the recorded on this one, and we'll find them. You can find them all on the AEA SIM TIG YouTube channel. We'll send a link to that as well. Each webinar in our 2023 series touches on the 2023 AEA conference theme, which is revolving around storytelling, and just shouting out that we're excited for that conference in October. I am going to just introduce Michael briefly, and then we'll hand it over to him. I'll mention, I suppose, just before that our next webinar is going to be in June. Ben will mention this again at the end. It'll be presented by Jonas Hunter and Paul Lessert from Raven Indigenous Partners, and it's going to focus on an Indigenous perspective to impact evaluation. So if you haven't yet marked your calendars, that'll be June 7th with details and timing TBD, but be on the lookout for information. So Michael, we are so glad to have you here today. We feel really lucky that you're presenting some of this research pretty fresh and pretty new, and inviting conversation around it. For those of you who don't know Michael, he's the type of person who really enjoys a great and hard question, so save those up for the end. Michael is the head of research at the Wharton ESG Initiative, where he helps to lead research on impact investing, corporate social responsibility, and the broader ESG field. In addition to his work at Wharton, Michael maintains an active independent consulting practice and has worked with organizations such as the Urban Institute, Rockefeller Philanthropy Advisors, Ashoka, and Johnson & Johnson. And prior to taking on his work at Wharton, he completed a PhD in sociology at the University of Chicago, where he conducted research on the history of the US human services sector. So without further ado, and with that fairly long intro under our belts, Michael, let me hand it over to you.
Great, thanks, Lissa. I just want to confirm before I start, everyone can see the presentation screen. Looks good, great, okay. I do want to mention I have a bit of a cold, so please excuse the occasional cough here, and hopefully my voice will hold up. Great, so the title of this presentation is Should Impact Investing Be Hard? Thinking about difficulty when evaluating impact investing contribution. And I just want to acknowledge that the question, should impact investing be hard? It might seem like an odd question to ask, but I actually do think it's an important one, and also a timely one. And to make the point of why this is a timely question, I'd like to start this presentation with some data on the popularity of impact investing as a Google search term. Okay, so here's the graph. You can see the emergence of the term following the famous convening at the Bellagio Conference Center in 2007. And then you see some pretty impressive growth until around 2018 when it clearly starts to level off. It looks like there could be some recovery, but overall the shape of this line suggests that the growth in popularity of impact investing has plateaued to some extent in the past few years. And there are other ways you can sort of glimpse this. If we could just make sure that everyone else is muted, thank you. Now to make sense of this plateau, I'm going to add a line for the search popularity of ESG. So now you can see the two trends together with ESG there in orange. And bear in mind, these are ranked data. The lines are on different scales. So you want to look at the shape of the line, not the height. So this graph is not telling you that impact investing was a more popular search than ESG was in 2015. What it is telling you is that there was a surge of interest in ESG starting around 2018, 2019. And that surge coincided with the leveling off of interest in impact investing. Now, I'm curious how you all are responding to these data, but from my perspective, this fits with what I'm hearing and sensing in the field from my conversations and interviews with impact investors. There's clearly growing interest in ESG, and impact investing is starting to get overshadowed to some extent, it seems. Just on a personal note, this trend shows up in my own organizational affiliation. Until about half a year ago, I was employed at the Wharton Social Impact Initiative, which was focused very much on impact investing, but has now been restructured as part of the Wharton ESG Initiative. And to be clear, I'm still as excited as ever to be part of what Wharton is doing in this space. And we still have an impact investing research lab, but it's part of a larger center focused very much on ESG. And I think I'm not alone here when I say that the growth of ESG, as shown in this graph, has been really exciting. But this tremendous growth also raises the question of whether impact investing is getting lost in the sauce here. What's the future of impact investing? Now, there's long been the question of what really differentiates impact investing from ESG. As I think most of you know, and as shown here, there's no shortage of infographics and frameworks that try to get across this distinction or spectrum between ESG and impact investing. But frameworks aside, I think most of us would acknowledge that there has been an effort to keep a big tent approach in impact investing, even at the risk of fueling some of this ambiguity over what is impact and what is ESG. So taking a relatively inclusive approach, not scaring off or alienating too many folks, that's been a clear and important strategy for building the field of impact investing. But I think that looking at this graph again, now might be the time to really reflect on whether impact investing needs to assert and differentiate itself a bit more, because the fact of the matter is that many people are confused about where ESG shades off into impact investing. And as long as there's that ambiguity, I think practitioners and others will understandably just opt for the term that reflects greater market share. And so that's why I think the popularity of the concept of ESG seems to be coming at the expense of the popularity of the concept of impact investing. And this is where we need to talk about contribution, or additionality, as some call it, because the idea of contribution is all about what differentiates impact investors from other investors. Now, it might be useful to do a quick refresher on what contribution is as a term of art in impact investing. So I'm going to defer here to the website for Impact Frontiers, which is, as many of you know, is the successor to the Impact Management Project. In their recent draft for public consultation on definitions and strategies for investor contribution, the Impact Frontiers team puts forward the following definition, which I think is quite good. So I'll just read it really quickly. Investor actions that cause or are expected to cause a change in outcomes for end stakeholders, the natural environment, and or systematic risk that would not have likely occurred in the absence of those actions. I'm not going to get into systematic risk here. I think it suffices to say that we're talking about counterfactuals. We're talking about impact that we have good reason to believe would not have occurred if the investor had not made the investment they made in the way that they made it. Now, just to flesh out this definition, the Impact Frontiers site has a really important contextual note, which I'm also going to read over really quickly. Enterprises and investors operate in a dynamic social system with various actors, from competing firms to government bodies to NGOs, seeking to contribute to the same set of outcomes. So just to unpack this, the context for understanding and assessing contribution is that there are other actors in the market that also contribute to social and environmental outcomes, And so the idea of contribution is to take stock of this broader ecosystem and to determine, based on that contextual awareness, what unique impact value add an impact investor brings that justifies that title of impact investor. So the theory, in short, is that impact investors are supposed to go where other investors don't, or invest in ways that other investors do not, in order to achieve impact that probably would not otherwise happen. Okay, so just to bring this back to impact versus ESG, I'm going to invoke a very helpful graph from Tideline, which helps to explain that impact investing has generally emphasized this criterion of contribution to an extent that ESG has not. Okay, so this graph shows that impact investing in the top right there is distinct from other types of investing, including ESG, in terms of greater intention to achieve positive impact and in terms of contribution. So if impact investing is going to remain distinct and important, I think we really need to focus on contribution. But it's also worth recognizing that the contribution or additionality criterion has been a bit controversial because it seems to imply concessionary returns. The most intuitive way by which an impact investor can differentiate from traditional investors is to prioritize impact over financial returns, either by explicitly targeting lower returns or more indirectly through a subordinate position in the capital stack or taking on a lot of extra transaction costs, et cetera. Basically, if the deal is financially attractive, it's often reasonable to assume that the counterfactual is that some other purely profit-driven investor would pursue the deal in that way. And so therefore, the degree of contribution is questionable. Now, of course, as we've seen from the GIN data, many impact investors target competitive market rate returns. This is a figure from the GIN's last annual survey, which shows that about 2/3 of the respondents target risk-adjusted market rate returns. And then this figure from their survey shows that most respondents report meeting or exceeding their financial performance expectations. And there's actually evidence supporting that many impact investors achieve market rate returns. This is a forthcoming academic article on the subject, which shows that impact private equity and venture capital funds show risk-adjusted performance similar to that of their non-impact counterparts. And so it's perhaps problematic to think of contribution in terms of concessionary objectives, given this reality that many impact investors are apparently achieving risk-adjusted market rate returns. And so this is where the issue of difficulty arises. So again, contribution is about achieving value-added impact by doing things that traditional investors don't do. If we're not talking about concessionary returns, then it might make sense to think of contribution in terms of difficulty. In other words, thinking of contribution in terms of taking on work that enhances impact and that traditional investors can't be bothered to do because it's extra work that's not material to their objectives. And it's reasonable to assume that impact investors are experiencing this extra difficulty because presumably impact investing involves all the conventional responsibilities of investing, plus whatever activities come with prioritizing impact, right? So inspecting earnings reports, following market trends, meeting with management teams, courting potential co-investors, and so on. And then on top of that, whatever work is involved in trying to make a dent in climate change, racial injustice, educational inequality, et cetera. So to dig into this topic of difficulty, I've worked with Professor Catherine Klein at Wharton to develop a survey that we're using to build the Impact Finance Database, which is a comprehensive repository of information on 220 impact investing funds and growing, particularly in private equity and venture capital. And in that survey, we included questions on this issue of difficulty. We asked impact investors to report on how their work compares to traditional investing when it comes to these activities at the bottom, sourcing potential investments, conducting due diligence, attracting and securing investors, hiring and retaining employees, meeting financial targets, winning competitive deals, and exiting successfully. And so respondents could indicate that impact investing makes the activity much harder, somewhat harder, about the same, somewhat easier, or much easier. Now, because we're short on time, I'm going to go straight to what I think is the most important finding from these data. So here's the most important pattern I found in the data. There's a lot going on here, so we'll talk through this slowly. Okay, so here we have 7 clusters of 3 bars each, and each cluster, that is each set of 3 bars, presents the response data on one of those activities that I mentioned before. You can see them along the horizontal axis on the bottom there. The darkest bars are for respondents who identify as market rate seeking. The middle shaded bars are for those who identify as below but close to market rate. And the lightest bars are for those who target returns that are at or near capital preservation. So those are the most concessionary funds. I went with shades of green because it sort of evokes money to many of us. So the darker the green, the greater the emphasis on market rate returns. And here, just to simplify the presentation, I'm just showing percentages who report that the given activity is somewhat or much harder in impact investing. So I've simplified the data just a bit to make it easier to present. Okay, so just to clarify, if we look just at sourcing potential investments for a moment, what we see is that just under 50% of market rate respondents think that this activity is harder in impact investing than in traditional investing, while 70% below but close to market rate respondents think it's harder. And then nearly 90% of the more concessionary respondents think that sourcing potential investments is harder in impact investing. And that pattern holds across the board. For all the activities we asked about, concessionary impact investors were more likely to consider impact investing to be harder than traditional investing. Now, just to be clear, there are other findings we could discuss. We could talk about why all of these bars aren't higher. We could talk about why certain activities like due diligence seem to be harder in impact investing than others, like hiring and retaining employees. But I only have so much time, and so we're going to focus on these differences among investors targeting different returns. Okay, so that's what we're going to focus on here. Why do we see these differences? It probably has something to do with the fact that concessionary investors often work with smaller companies with less experienced management in regions that may be more challenging to do business in. These investees may be harder to pitch to co-investors and may also require more technical assistance. So from that perspective, it makes sense that concessionary investors find impact investing to be harder. But on the other hand, if we assume that market rate impact investors are meeting that contribution criterion and therefore pursuing market rate returns while also taking on work that other investors wouldn't bother with, then they should find that balancing act pretty difficult, presumably. It's unclear why they're significantly less likely than their concessionary counterparts to view impact investing as harder, why they're less likely to view impact investing as harder. And so to gain some clarity here, I think we need to get deeper into the psychology of impact investing. And to do that, I'm going to draw on some research that I conducted with Lauren Kaufman. These are a couple of publications that you can look up to learn more, but basically we interviewed staff at 135 impact investing organizations to learn about their practices. And one of the clearest findings from this research is that it's common for impact investors, and especially market rate impact investors, to believe that impact and financial performance are highly correlated in their deals. We actually coded our interviews according to whether that belief and that correlation surfaced in conversation. And the difference is quite significant. This is the breakdown we came up with after comparing our coding. 73% of the market rate investors that we interviewed made this claim of seeing a win-win between financial performance and impact in their deals, while only 22% of below market rate investors made that claim. Now, in practical terms, what we found to be the result of this mentality is that market rate impact investors were more likely to believe that they can proxy the impact performance of their investees essentially by measuring their business performance. Now, doing that obviously simplifies things considerably when it comes to the processes of investing. And here are a few illustrative quotes from market rate investors demonstrating that simplification. I'll just read these very quickly. At the top there, the more financially successful, the more impactful, the more financially successful. Another market rate investor says, our impact strategy is built into the business strategy, so we don't have to try too hard to measure impact because it's already built in. And then the last quote there is, in essence, the KPIs for social impact are inherently built into the financials. So you can glimpse here how some investors view impact as something that's very intertwined with business performance, with the result that it really simplifies impact measurement. And in fact, what Lauren and I found in this research was that a lot of impact evaluation is actually financial performance evaluation. Particularly for market rate impact investors, the impact of impact investing is often very front-loaded. Most of the attention to impact happens during screening and due diligence. And once an investee is designated as impactful, a lot of what the investor does is basically conventional investing work. Impact measurement itself is often used more for marketing and communications to advertise successful investments, not so much for true performance evaluation and impact management. And again, this was especially the case for market rate impact investors. Now, this interview research that I'm referencing here pertains specifically to impact measurement, but the basic underlying idea of this fusion of impact and business performance likely applies to other domains of impact investing as well, such as the ones we focus on when collecting these data. If you believe that impact and business performance are highly correlated, then you can think of any business enhancing work you're doing as something that doubles as impact enhancing work. which is why I think we see that market rate impact investors are the least likely to perceive extra difficulty in these activities. Now, in terms of contribution, this raises serious and interesting questions about whether and how often impact investors are meeting that important standard for achieving value-added impact. Because again, it seems likely that a lot of those value-adding activities pertain to enhancing business performance and are therefore likely to be quite similar to what non-impact investors would do as well. Okay, so I want to pause here and recognize that I'm making some arguments that might seem provocative. So I just want to take a minute to clarify what I'm arguing and what I'm not arguing. Okay, so first, I am arguing that there appears to be a pattern where market rate impact investors are more likely to simplify the work of impact investing by viewing impact through a more financial lens. I am not arguing that this is the case with all market rate impact investors. We all know of examples of market rate seeking impact investing firms that prioritize their returns and also engage meaningfully and substantively with impact as a distinct and important concern. Second, I am arguing that the data suggests that much of the work that many impact investors, and particularly market rate impact investors, are doing closely resembles what traditional investors do, especially after due diligence. That's the finding with impact measurement from my past research, and it's what these data on reported difficulty seem to be suggesting, though I do think this needs more research. I am not arguing that because this work closely resembles the work of traditional investing, it therefore is not impactful. It can definitely be impactful, and there can definitely be a strong correlation in an investment portfolio between impact and financial performance. But the point here is that all investors and all investments have impact. And what's supposed to make impact investing special and unique is the premium placed on positive impact and the counterfactual thinking that goes into ensuring that this impact is above and beyond what we're getting from conventional market dynamics. So just to illustrate that point, when we look at, for example, this guidance on demonstrating contribution from the IFC's operating principles for impact management, there's this footnote that I've highlighted where they give examples of contribution, many of which would seem to apply quite easily to traditional investing, right? So improving the cost of capital, active shareholder engagement, creating long-term trusted partnerships, providing technical assistance, helping with operational standards. These are all potentially great ways to optimize impact, but they're also examples of what non-impact investors frequently do, especially in private markets. So we need to be careful about understanding when and how these activities are deployed in ways that optimize impact beyond what a traditional investor would accomplish just by trying to improve business performance. Now, I admit that it could seem that I'm being a bit too fussy about standards of contribution, but again, the context here is that I think we're at a time when impact investors need to be more deliberate about differentiating their practice. Underlying this whole topic is sort of an existential question for impact investors, which is, what is the purpose of impact investing? Should it be the vanguard of the responsible investing movement, or should it be just sort of a synonym for it? You know, if it's the former, if it's the vanguard, then we need to start thinking of impact investing increasingly as impact first investing, catalytic capital, all of these models that really stand apart in terms of contribution. And to be clear, there's definitely a place for achieving market rate returns in those models, but my sense is that achieving market rate returns under those constraints should, generally speaking, be hard, or at least it should be harder than it's looking right now. Okay, so in this last minute, I'd like to wrap up by recapping the main points of my argument and drawing out the practical implications here. I've put a lot on the table, so I think a quick recap would probably be helpful. So here it goes. I'll try to be quick about this. So first, impact investing needs to differentiate itself, and that requires emphasizing contribution. Contribution consists of activities that cause impact that likely would not have occurred without those activities, and it's achieved by investing in ways that non-impact investors generally do not invest. For market rate impact investors, which is a sizable chunk of the sector, achieving contribution presumably can't involve concessionary returns. So in this case, achieving contribution would seem to require taking on work that non-impact investors would pass on, and that implies extra difficulty. But market rate impact investors generally do not find impact investing to be harder than traditional investing. And part of the reason, I think, is that they often equate impact and business performance, which enables them to quite understandably view normal investing activities as impact optimizing activities for investees that are deemed impactful during screening and diligence. This tendency raises the serious possibility of marginal levels of contribution, particularly among market rate impact investors. And to recenter contribution and impact investing, we need to interrogate this fusion of business-focused and impact-focused work. We need to really seek out evidence of value-adding activity that traditional investors would not carry out or are not carrying out. Now, as evaluators, there are two basic takeaways here. One is to be clearer on what contribution is, why it's important, and how we're evaluating it. This should not be a formality. It's obviously really important. Second, in terms of the practical matter of evaluating contribution, we need to really engage in that counterfactual thinking exercise with reference to what we know about what traditional investors do. So again, lowering cost of capital might be great for optimizing impact if impact is thoroughly embedded in the business model. But if we have good reason to believe that any competent profit-driven investor would take measures to lower the cost of capital for an investee, then we really need to look beyond that for evidence of contribution. Or we need to be quite confident that traditional investors are just not working in that particular market. And I think a good indicator of all of that is the degree of difficult extra work that the investor is taking on. Okay, so I'm going to wrap it up here. I'm eager to hear what you all think. So thank you for your attention and your time.
Great. Well, thank you so much. What a wonderful presentation. And I think the decision to have that summary wrap up or recap at the end is a really good practice for our presentations.
Yeah, especially for dense ones, right?
Really centers everything right at the end. So thank you so much. We're very grateful for you sharing this really fascinating research. Now we want to give an opportunity for those attending today to share your questions. We have an initial one in the chat, so maybe we'll start there. And then I encourage people to either post in the chat or raise your hand if you'd like to directly present your question. But why don't we start with the one in the chat, which is to clarify what the regions or countries were that these investors in the survey were investing in.
So at a high level, we have global representation of impact investing firms in the sample. There is a bias towards North America, and we are working on getting more investors into the sample who are active in other parts of the world. But we do have a fairly global sample.
Great. Well, next I see that Philip has his hand up, so I'm going to pass it over to you. And if you'd like to directly share your question, please feel free.
Thank you, Ben, and thanks, Michael, for the presentation. Really thought intriguing. I guess sort of two aspects to my question. I think the first one, and I'm not 100% sure I sort of whether I got this right, but I think if you bring it back to your first chart, ESG versus impact, I would disagree if you're trying to make the point that there's investor contribution and impact, but not an ESG, right? So I think you can actually have investor contribution in both examples. And I think if you look at the sort of draft SDR regulation in the UK here, so I work for Big Society Capital, impact investor with a UK focus. I think that's reflective in there that you actually sort of lay out investor contribution across the different sustainability levels, including the improver label, which I think sort of speaks to ESG. I think that's the first point. And if that's then right, then I think the sort of the way forward would be definitely be clearer and more specific about investor contribution to differentiate. So I agree with it, because the investor contribution will be a different one. But I think there's also real importance to come back down to the enterprise contribution, because I think it's there where the difference lies between an impact investor or an ESG investor. Yeah, so thoughts, questions, but it would be great to sort of get your take on that, Michael.
So I think that this is there's controversy over this. I think there's still an open question on the degree of contribution that you can achieve in public markets, which is what we generally associate with ESG. That's becoming less so the case. It feels like by the hour. I think that I didn't mean to suggest that you can't achieve contribution completely in ESG, but I do think that contribution has generally been more pronounced as a standard in impact investing. So I think that there's a belief that you can achieve greater influence on company operations in private markets, and that the standard and the importance of contribution is just more salient, or just it's greater in impact investing than in ESG. And I think that those two things are interlinked. You know, the reason there's a greater premium placed on contribution in impact investing is because impact investing has typically been associated with private markets, and it's widely believed that you can achieve greater levels of contribution in private markets. So that, I hope that's responsive to your first point, and my voice is starting to go here. I can tell. So I'll try to just bear with me. Now, in terms of the linkage between enterprise contribution and investor contribution, I agree that investor contribution really can only be an important thing to think about if there's, you know, again, if it's linked to enterprise contribution. And I think that that's why it's good that the Impact Frontiers definition of investor contribution references changes in end stakeholders and in the natural environment, because, you know, that work is not being done simply by the allocation of dollars. That work is being done by you know, the generation and delivery of products and services that the actual investees are doing. So there definitely needs to be that linkage there. So I guess I just agree with that point.
Great. All right. Well, the questions are coming in fast and furious here. I will next ask or present Anne's question from the comments, which is, how does this analysis change or not if one considers impact investing, particularly in private markets?
So by analysis, do we mean like my argument overall, or the charts? Maybe just like a follow-up clarification. What do we mean by this analysis?
I'll just speak. It's easier than typing. Thank you. Now, I meant the data in general, you know, the report results.
I see. So
because it wasn't clear if you're speaking mostly about public or private markets. And so if there's any difference there.
I see. Yes. So the IFD is composed of funds in almost completely in private equity and venture capital. So we're referring to private markets here.
Great. Thanks.
Great. I'll turn it over to Stephen. If you have your hand raised, if you want to directly share your question, please feel free. And seemingly you've gone off mute, but we can't hear you, or at least I can't. All right. So while you sort that out, we'll just pass it over to the next question from Jose then. Who's asking, isn't the bottom line message here that impact investors need to pay more attention, or at least better argue, their non-financial additionality?
So no, I don't think that's the takeaway, because and maybe I'm misinterpreting what's meant by non-financial additionality. I think that so my assumption is that financial additionality means, for example, making concessionary investments, right? So if you're targeting a lower rate of return, that is not what a traditional investor would do, presumably. So that's the easiest way to meet the contribution standard in my mind, at least, right? So both count, financial additionality and non-financial additionality. Non-financial additionality would be, for example, the provision of operational and technical assistance. I do think that is more relevant if you're a market rate impact investor, because presumably you're not going to meet the financial additionality criteria, because you're not making concessionary investments. So in that case, we are looking at non-financial additionality. And so yes, for market rate impact investors specifically, we need to be thinking more carefully about how exactly that happens. And just as a contextual note here, I do think that is generally what we mean by contribution in the context of market rate impact investing. It's generally through active investing that market rate impact investors make the claim to contribution. I mean, if you look at the disclosures of the signatories of the operating principles, you're seeing a lot of reference to operational and technical assistance. And that's not a random sample of market rate impact investors. Those are funds that are in the orbit of the IFC. They're very active in emerging markets. And even in that sample, you're seeing a lot of reference to technical assistance and working closely with investees. So So I guess this was a bit of a long-winded answer, but both are important, financial and non-financial additionality. When we're talking about market rate impact investors, yes, non-financial additionality is more salient.
Great. Well, Stephen, why don't we try again and see if the problem's solved? And it's not. Shoot. All right. Well, we'll work it out one way or another. You feel free to also share it in the chat if that's going to be an easier way for us to hear from you. Veronica posted a question in the chat saying, as you know, in evaluation, the attribution versus contribution issue is a touchy topic with methodological implications. Are you also implying a technical pairing with your argument?
A technical pairing of attribution versus contribution. So, I mean, it might be worth just clarifying terms here. When I think of contribution, I think of that counterfactual exercise that's, it's sometimes synonymous with additionality. Attribution, I interpret personally as the fraction of impact that an impact investor can claim. Is that how, am I understanding those terms correctly, Veronica?
Trying to get off mute, and I really want to know what Stephen's question is, so maybe he can put it in the chat. They're just charged words. So if we think about an attribution world, we're typically talking about causality, and we're talking about counterfactuals, and we're talking about randomized control trials, which is a normalization of what the non-evaluation world thinks of as evaluation, which is risky. And so, and I had a sense that you weren't using these terms in this way, but given that we do have an evaluation market, so to speak, here today, I just wanted to clarify, are you intentionally also arguing that there is only a few different ways for us to be then assessing and analyzing the contribution piece from a, what did you call it? From a counterfactual perspective. That's the clarity. I do want to say that to Jose's point earlier, I was thinking that I was going to ask, is the bottom line there also that impact washing is basically more predominant than we even think it is, just based on your analysis? So that's a separate comment. That's more commentary.
Yeah. If you don't mind, let me just address the impact washing point first, because I mean, this is recorded, and I'm now officially on record making some pretty provocative statements. So I do want to be very clear here that I am making no accusations about impact washing or greenwashing. I think that impact washing relates to intention. I interpret impact washing as making claims about impact while not really actually caring about impact. And I want to be very clear that I think from my extensive experience talking to impact investors, including market rate impact investors, they often check all the boxes on intention. So they are very committed to achieving impact. And so given that experience and the relationships that I've made in the impact investing space, I do not think that this is evidence of impact washing based on how I interpret that term. So this is not, I'm not impugning anyone's intention about impact here. Now, as far as contribution and attribution and additionality, from my understanding of the question, Veronica, my response is that I don't think there's only one way to demonstrate contribution. I think that if an impact investor has the resources to recruit an academic to do a full-fledged randomized control trial, that's great. But, and that might get closer to this question of attribution, that is like, the fractional portion of impact that an impact investor can claim. I think that generally speaking, the understanding is that impact investors are not able to go that far in their evaluative work, and neither are the third parties that they engage. So often it's about narrative. It's about whether you have a plausible narrative supporting your claim to contribution. And so we're using kind of quick, dirty, rough proxies for contribution. In many cases, that proxy is just the following question. Do we have good reason to believe that a non-impact investor would pursue this deal in this way? I think that is the lowest hanging fruit for demonstrating contribution in many cases.
Great. Excellent. All right. So now we have Stephen via chat this time, sharing that a recent Harvard paper suggests that impact investors who co-invest with traditional investors are non-additional. Do you think that we should consider crowding in non-impact capital as part of our contribution?
Yes, that would count as contribution. I guess it depends on how the crowding in is happening, right? Like just having co-investors is not necessarily crowding in. I think of crowding in as bringing co-investors into a deal who would not otherwise, again, just going back to this counterfactual exercise, we're bringing in investors who would not otherwise invest in the deal, either because the deal terms are not attractive or because it's not on their radar. Or could often we associate this with taking a subordinate position, you know, exposing yourself to more risk, de-risking the investment for other more kind of mainstream investors. I think that that's the mechanism that we generally have in mind there. I'm not familiar with the paper that's being referenced here. Oh, actually, I have seen that paper, but I have not read it yet. So I can't really comment at length on that.
Great. John then asks, aren't impact investors trying to create impact in the world beyond their financial returns and operations? If so, do you believe they have a responsibility to understand and or measure their impacts? Why doesn't that help differentiate impact investors from other types of investors?
I'm glad that this question is written down because I want to read it again. Aren't impact investors trying to create impact in the world beyond their financial returns and operations? So the answer is yes. I think that is the intention. So when I hear the word trying, I think of intention, right? So intention is a big part of impact investing, but it's long been, it's pretty much recognized at this point that it's necessary but not sufficient, right? So intention is the starting point, but you have to go beyond intention. The other big criterion is managing that impact and being additional in that impact. Again, additionality and contribution is kind of controversial still, but I think in most established venues, like this is a really important part of impact investing because all investments have impact. Like, you know, Pfizer had an impact when they developed the COVID vaccine, and being an investor in Pfizer didn't make me an impact investor. So there's impact happening just as a natural byproduct of, you know, the reconciliation of supply and demand, technological innovation, all of the things that we get naturally in the market. Impact investing is not just piggybacking on that naturally, so to speak, you know, sort of baseline impact. Impact investing goes above and beyond that, and that's where the contribution comes in. So it's more than trying. And so do you believe that they have a responsibility to understand and measure their impacts? So yes, I believe they have a responsibility to understand and measure their impacts, but it can't just be the passive tabulation of impact metrics. You know, there has to be sort of a more actionable takeaway from impact measurement. I think that's where impact management comes in, and that gets to the issue of contribution. So if you're measuring your impact, there needs to be an intention there to actually use the data to optimize impact in some way, in a way that would not otherwise happen. So I hope that's, why doesn't that help different? So I hope that's responsive to the question, but happy to clarify if I can.
Great. All right. So another question that follows on it from Catherine is around regarding impact washing. However, shouldn't we have a higher standard than intention? I am loath to be incendiary here, but I think the field needs help understanding what kinds of evidence is needed to make impact claims and claims regarding the counterfactual.
Shouldn't we have a higher standard than intention? I think this really just boils down to how we understand impact washing. I think of impact washing as like a pretty serious act. Like it strikes me as a pejorative that I just don't want to be on record making any claims about. So, you know, I think that the standard for impact, the standard that I use for impact washing is an issue of intention, using marketing to, you know, to make money while by making, like, you know, spurious claims about impact with the intention of, like, you know, being deceptive in that way. That's how I interpret impact washing. I think there's a separate issue here of just kind of the more technical question of whether an impact investor is meeting a particular standard, in this case of contribution. I think contribution stands apart from intention and impact washing. It's just about standards of practice. So I do think we need to have higher standards of practice. That's what I've been arguing in this presentation, but I'm really hesitant to let that bleed over into claims of impact washing.
Great. Well, I think that's it for other people's questions. Maybe I'll just ask if you have any, if you'd like to build on your last point a little bit. I think a lot of your presentation very rightly focused on your findings from the research and what that potentially implies. I'd love to hear a little bit more about whether that research also suggested to you, part of it is the things that evaluators can do. I think you pointed out quite clearly. Do you think even beyond evaluators that there are things that can be done, or is this just going to be the eternal challenge we face, where there are, kind of a continuum of levels of interest, perhaps in the extent to which impact's having and use of a term in different ways that isn't necessarily always standardized? Did anything else come out from the research that suggests potential ways forward on how we might, better have some clarity here?
There's a lot of data in the IFD that I'm still sifting through, and a lot of it does have practical implications for evaluators. I'm not prepared to get into that additional data yet, but just focusing on the data that I presented here, I think that evaluators are in a tricky position. I say this as someone who has, as Lisa mentioned in the introduction, I have an independent consulting practice. It's an important part of my living, so we all feel the need to accommodate our clients to some extent. And so there's always going to be this balancing act. And I totally understand and respect that from personal and professional experience. But I just think that it's important to keep in mind what are the stakes here, because I care about impact investing as a movement, as a sort of a vision for the role of capital markets. And I think that ESG is, controversy aside, I think it's great how much attention it's been getting and how popular it's becoming. But I think that it is important that we carve out and consecrate a space for impact investing, which is really, I think, still distinct from ESG. And so insofar as you as an evaluator see yourself as an agent of the impact investing movement, I think that the practical takeaway here is take it on a case-by-case basis, but whenever possible, kind of stick to your guns on stand your ground on the contribution point, because, and I think that will actually help generate business. If you cultivate a reputation for being an evaluator who goes the extra mile on demonstrating contribution, you will get business from impact investors who are looking to differentiate themselves in that way. I have some rough, I think that Sarah from Bluemark was on this call, or perhaps still is on this call. Like, I'm really curious how they approach this, because when I look at the verifications of the operating principles disclosures, Bluemark's looks different. It looks like they put in extra work. And so I'm wondering, if she's on the call, if she's still tuned in, if she has any thoughts about that kind of strategic choice, if I've characterized that correctly.
Oh, well, thanks for that. Yeah, I'm happy to chime in. I think there's a lot to say, but I do hope that through our rubric and our verification instrument, looking at the way managers align with the principles, we're setting a high bar for what constitutes meaningful contribution, and looking beyond just folks kind of talking about what they say they want to do, but really having evidence that they're evaluating the potential of their value add early on and exploring the potential of certain investments, tracking what it is they're actually doing, and having the same kind of discipline of tracking their contribution the same way they ask their companies to track their results, and then trying to gather evidence about what's working and not. So I think we take the contribution component of the principles pretty seriously and look for a lot of evidence. But this conversation in general has been really thought-provoking, and I really appreciate the research, Michael. I just wanted to add that too.
Thank you.
Great. Well, Ben now has a question he's posted, asking, what do you make about the fiduciary duty-related arguments to make less risky and potentially less impactful impact investments? For example, around Forex risk, mismatches between institutional ticket sizes and absorption capacity of SMEs, etc.
What do I make of the fiduciary related arguments to make less risky. Yeah, I mean, it's a serious issue, right? Like if I'm right, and if contribution for market rate impact investors means taking on extra difficult work in order to differentiate from non-impact investors, that makes it, I think, again, the argument here, the question is, should impact investing be hard? The answer, I think, is yes. So yeah, that poses an issue for fiduciary duty. Now, I'm not a lawyer. I don't know exactly what the workarounds there are for fiduciary. I know that the IRS has put out some interesting clarifications on, like what constitutes risk and prudent investments for, foundations investing their endowments. So like, I think that there could be some wiggle room here, but so I don't want to get into those details, except just to kind of point out that they may exist. But I think that at a high level, it does seem to pose some puzzles on how market rate impact investors would thread that needle.
Great. Well, I think we'll only have time for one last question. So I'll turn it over to Veronica before we let you all know about the next webinar in our series.
I just had a question, and I'm glad Sarah weighed in. Yeah, I wanted to get a sense of, back to the choice around how we prove contribution, and being on the asset manager side. I think I have so many thoughts, but one of which is would it be reasonable then to say that one of the ways one can behave in a way that's delivering on that impact intent is through just regularly commissioning a third-party review of your investment portfolio? Because to me, that's like my simple message typically to the decision makers on my side. It's like, there's lots of things we can do. This stuff is really complex. It's really technical sometimes, but if we at least get a third-party assessment to come and check us in, that helps us with the conversation around contribution, the conversation around impact washing. And I'm curious, Michael, would you say that feels reasonable, or is there something else that we should be doing along the way aside from like the impact management piece?
I think that's a good start. I think that getting a third-party review is, if you can afford it, it's a good start. It is a way of differentiating. But I think the question still remains, like, what do you do with the information when you get it, right? Like the third-party review points out various ways to change operations to improve impact. Does that report sit on a shelf somewhere and collect dust, or do you actually marshal your resources to make those changes? And again, contribution lies, I mean, obviously, this, Veronica, so I just want to be clear that I'm just kind of making this as a general point. The contribution is not a binary. It's not like either you're not contributory or you are. There's a whole spectrum here of contribution. And I think the beginning of that spectrum is just being interested in the information in the first place through, for example, commissioning a third-party review. But there's a whole, you can take that information as far as you want.
Yeah, that was my assumption, that we would do something with it in terms of being able to kind of deliver on the adaptive management piece. But I just wanted to try to demystify it a little bit, because I know that many of my decision makers believe in assurance processes, because they see financial assurance processes, risk assurance processes. So impact assurance to them kind of just falls naturally there. And I just wanted to get a sense from you, based on your research, whether or not that would feel like it would comply. And I guess more importantly, do you get the sense that your sample size sees that as well? Or do you get the sense that they think they have to do other things to be able to at least start that journey?
The sample is all over the place in terms of how much they prioritize impact. Which is a good, because you want to have a lot of variance in a sample, right? And we have various ways of measuring that. So there are definitely some funds in the sample that actually we asked about that do have a third-party evaluator involved, and some that don't, and probably don't have any interest in doing that. So it is sort of all over the place.
Great. Well, we're all very grateful that your voice held up for the full hour. It's fantastic, as well as all of the great information that you shared. So thanks again. We're very appreciative. As promised, we're going to post this. So if you know others who weren't able to join today, but still are interested in hearing more about it, we're going to circulate the link so you have the chance to see it on the YouTube channel. And as promised, I also wanted to mention that this is one in a series of webinars that the AEA SIM TIG is putting on this year. Our next one is in June. The topic is going to be around impact measurement from an Indigenous perspective, featuring Paul Lessert and Jonas Hunter from Raven Indigenous Partners. So that'll be happening June 7th at 9 a.m. Pacific time. I'm also posting that in the chat, so you have the details. And of course, we'll be circulating that again prior to June. So thank you very much to everybody. And I think we'll close it.
Thanks, everyone.